In 2008, Warren Buffett gave Goldman Sachs a $5 billion lifeline to shore up the bank following Lehman Brothers' collapse, and he gave Bank of America a cash injection in 2011 after its stock plunged amid losses tied to subprime mortgages.
He's been regarded as a savior of ailing banks in the past, and according to people familiar with the matter, there have been multiple calls between the billionaire and the Biden White House senior advisors in recent days, specifically about potentially investing in the U.S. regional banking sector. We also know that Buffett has given some of his views and broader guidance about the current banking crisis.
The sudden failure of Silicon Valley Bank on March 10, 2010, triggered the most serious crisis of bank confidence since the 2008 Great Financial Crisis, which devastated the global economy and threatened to bring the financial system to its knees. The Californian bank had wagered on interest rates by purchasing high-quality bonds. The issue was that SVB purchased these bonds and mortgage-backed securities when interest rates were low and did not protect itself if rates rose. The bank simply did not hedge its risk. The bank's bonds began to lose value when the Federal Reserve began raising interest rates in the second half of 2021. This issue coincided with the fact that SVB's clients, mostly startups and venture capital firms, could no longer easily find cash to finance their operations and projects, as had been the case during the pandemic, when the federal government printed money in large quantities. As a result, these startups began to withdraw funds from their deposits. To meet these withdrawal requests, SVB was forced to sell a portion of its bond portfolio and other securities. As a result of these sales, the bank suffered a net loss of $1.8 billion and needed to raise $2.25 billion to shore up its liquidity.
How can the individual investor protect themselves against potential bank failures, stock brokerage failures, and things like that?
Well, I think as a depositor with large banks or as somebody that leaves their securities with large brokerage firms, I really don't think you need to worry very much. We have a too big to fail doctrine operating in this country relative to what you might call the innocent parties in big financial institution failures. We don't have it in respect to the equity holders, nor should we have it. But I would not, I don't worry about leaving my securities, my personal securities, or for that matter, Berkshire securities, with the large securities firms. I don't worry about my bank accounts at big banks. So,
but you're talking cash accounts.
Yeah, cash accounts.
Not margin.
Yeah, and but if you, in terms of owning the equities of companies like that, or in terms of the fallout, the big thing that will, really the only way a smart person that's reasonably disciplined in how they look at investments can get in trouble is through leverage. I mean, if somebody else can pull the plug on you during the worst moment of some kind of general financial disaster, you go broke. And Charlie and I both have friends that have, where that's happened to them. But absent leverage, and absent just kind of going crazy in terms of valuation on things, the world won't hurt you over time in securities. And, I mean, you won't be subject to the financial cataclysms that they don't need to do you in. If you have any more money during periods like that, you buy.
Investors have since expressed concern about contagion, claiming that other banks may have made the same mistakes as SVB. The confidence crisis primarily affects regional banks and has spread to Europe around Credit Suisse, a bank plagued by scandals in recent years. To avoid a disaster, regulators needed to act quickly. They were forced to close SVB and unveiled a plan to guarantee all depositors in the bank, including those with deposits exceeding the $250,000 regulatory limit guaranteed by the Federal Deposit Insurance Corporation. Aside from the extraordinary new measure, the Fed has also established a backstop to lend money to banks, savings associations, credit unions, and other eligible depository institutions for up to a year by pledging U.S. Treasuries, agency debt, mortgage-backed securities, and other qualifying assets as collateral. These assets will be accepted at par value, or their original value, regardless of recent interest rate increases, which have reduced the value of long-term bonds purchased when interest rates were low. To summarize, the Fed does not want financial institutions to be forced to sell their bonds at a significant loss. However, these measures were not enough to restore trust, especially since regulators were forced to close another bank, Signature Bank in New York.
You know, in the old days, the only way you could stop a run on a bank was basically for somebody to come and pile up gold. I mean, they used to race it to the branches that were having a problem. I remember reading the history of the Bank of America on that and how they would put out runs before the Federal Reserve existed. And the only thing that stopped it was to pile up gold. I mean, if the CEO of the bank came out and said, you know, our Basel II ratio is 11.4%, the line would just lengthen. It would not get the job done. Gold got the job done.
Warren Buffett may come to the bank's rescue again, but he is unlikely to make as much money this time. The legendary investor and Berkshire Hathaway CEO is said to have discussed investing in U.S. regional lenders with senior White House officials. He has also provided advice and guidance to the Biden administration on how to deal with the current banking sector turmoil. Buffett may be preparing to play a role similar to the one he played during the financial crisis, when he made critical investments in Goldman Sachs, General Electric, and other companies when fear froze credit markets. He also called Treasury Secretary Hank Paulson to suggest the government invest directly in banks rather than buying their assets, which it promptly did. The billionaire's support could help to alleviate concerns about more bank failures and restore trust in the financial system. If Buffett demonstrates his willingness to put his money at risk in regional lenders, it may inspire other investors to hold on to bank stocks or buy them at a discount. It may also reassure depositors that their funds are secure. Buffett stands to benefit from the situation being calmed, as his financial stocks have been crushed in recent weeks. Berkshire's combined stakes in Bank of America and American Express have dropped by about $9 billion in the last month alone.
We will own bank stocks from time to time in the future. We'll probably buy stock in other banks. We've also seen all kinds of banks ruined.
Furthermore, Buffett negotiated favorable terms on his post-crisis investments and could do so again. Berkshire Hathaway profited more than $3 billion from its $5 billion bet in Goldman Sachs in 2008, and its money has more than doubled on paper since it piled $5 billion into Bank of America during the debt ceiling fiasco in 2011. Buffett demanded preferred stock that paid a high dividend and could only be redeemed at a significant premium in both cases. He also obtained warrants that he could use to purchase each bank's stock at a predetermined price in the future, ensuring that he would benefit if they made a comeback. Today, Buffett might try to strike similar deals with struggling regional banks. They would, however, be less profitable because the lenders in trouble are smaller this time, and both the federal government and Wall Street have demonstrated a willingness to contribute funds in recent days. In other words, Buffett may not be the only savior available, which limits his ability to negotiate the best terms for Berkshire.